Hey there students, Nathan here from Accounting University, and in today's video we'll be talking about how to calculate LIFO. Let's get into it. Okay, so first off, what is LIFO? I'm going to go through and kind of help you understand the concept, what it is, how it works, and then we'll jump into an example. So the first thing you need to know about LIFO is it stands for, and I'll reduce this a little bit. It stands for last in, first out. So last in, first out. So the last units you bought are the first to leave when you make a sale. That's how it works. The last units you bought are first to leave when you make a sale. So that's kind of, let me move this over a little bit. All right, so that's essentially what LIFO really means. In the FIFO video, if you watch that, I made an example about groceries. When you go and try to make a sauce, you should take the oldest tomatoes out first to make the sauce, and that's FIFO. With LIFO, last in, first out, again, it's the last thing that you purchased you should use first. We can use that same example with the tomato sauce. If you go to the store and you're buying tomatoes to make a sauce, you're going to want to use the tomatoes that you already had in your fridge first to make the sauce so they don't go bad. But let's say you're going to go to the fridge again. You bought some tomatoes, you're putting them away, and you see an old tomato in there. But that tomato, it's bad. It's gone really bad. You don't want to use it anymore. So in this situation, you would take the most recent tomatoes you bought to make the sauce. Same deal here. You take the most recent inventory, or you can say last inventory, the last ones you bought to use first for the sale. That's what LIFO is. And there's some rules about LIFO here that you should know. So the first rule here is, we'll go back over it, your last or most recent purchases go to cost of goods sold. That means your older purchases go to ending inventory. That's what's left over. So in a period of rising prices, what's going to happen is your cost of goods sold under LIFO will be higher. Now think about it. Your most recent purchases you took, the last purchases, usually are more costly, and that goes to cost of goods sold first, so your cost of goods sold will be high. In that respect though, ending inventory will be low. It's left with a lower value, so it lowers your assets, right? Inventory goes on your balance sheet. It lowers your assets. Lastly, if your cost of goods sold is high, that means your income is low, but also your taxes are low. So those are some basic characteristics of LIFO. Let's jump over to an example. So over here, I'm using the same numbers as in the FIFO video just to show you how LIFO works. So let me get my pen out, and yeah, that should be fine. So let's say that you sell, and we'll use a different number here. We sold 100 units, okay? You sold 100 units. How do we account for, we're looking for cost of goods sold. Oh, that's a terrible O. Cost of goods sold and ending inventory. Okay, those are the two things we're looking for. So let's go ahead and think about it. We sold 100, and we know with LIFO, to get our cost of goods sold, we take our most recent inventory out first to assign to it. So our most recent one was right here on December 7th. We sold 100, so let's go ahead and take out all of this 40 here. So now we know it's going to be $1,000 so far for that. Just to let you know real quick, your units are over here, your cost per unit, and the total cost. I just multiplied these together just to let you know. That's how those numbers came about. But back to the example. So we sold 100, and we took out 40 from this batch. We know this batch is 18. We'll take out all of that, so 396. We started with 100. Now we're at 60 because we took out 40, right? Now we're at 60 here. Now we took out 18. So now we're left to account for, what is that? 42. We have 42 units left to go. Here we can take out all of this 32, that entire amount. Now we're down to 10. So let's go ahead and take out the remainder here. And we get 10, but not the full amount, right? Because there's 25 here. So you took out 10, now you have 15 left. So 10 though we took. 10 times 18 is 180. So that's a dollar amount right here. Sorry for the bad drawing, but yeah, 180 is here. And we took out 384 here, 396, and 1,000. Let's add them all up. We'll start with 180. 180 plus going down, 384 plus 396 plus 1,000. And there you go. Cost of goods sold equals 1960. Okay, next, ending inventory. Well, we know what we have left. We have 15 units left at $18 right here. So just multiply those two together. 15 times 18, 270. And it's that simple. That simple. If you follow this system, it will work. Once again, know your rules. With LIFO, most recent goes to cost of goods sold, and then rest goes to ending inventory, and then look for your recent purchases and go down the line. Make sure you know your sales, start there, and go down the line. Use up 40, use up 18, 32, and add up your numbers. It's that simple, and whatever's left over is ending inventory. So hopefully that was helpful today. Once again, my name's Nathan. I do videos every single week for Accounting University. Thanks for watching. I'll see you in the next video.